Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Understanding OTC Derivatives, a key guide for financial markets in 2024. Risks associated with OTC derivatives. While OTC derivatives offer flexibility and customization, they also come with a range of risks that traders and investors must understand. Here, we'll break down 3 key risk areas: counterparty risk, market risk, and regulatory risks. Counterparty risk. Counterparty risk is the chance that the other party in an OTC transaction may fail to fulfill their obligations. Unlike exchanges, where a clearinghouse guarantees trades, OTC transactions rely heavily on trust between parties. Here's how it can play out. Default risk. If one party defaults, the other may suffer significant losses. For example, if a company enters a swap agreement and the counterparty goes bankrupt, they could face hefty financial implications. Creditworthiness. The financial health of the counterparty is crucial. Traders must assess their credit ratings before entering agreements. It's like lending money to a friend. If they have a history of not paying you back, you might think twice. Mitigation strategies. To reduce counterparty risk, some firms require collateral or use netting agreements. Diversifying counterparties also helps spread the risk. Always consider how you can safeguard your position. Market risk. Market risk refers to the potential for losses due to fluctuations in market prices. Since OTC derivatives are sensitive to market changes, understanding them is essential. Price volatility. The value of derivatives can vary widely with changes in interest rates, commodity prices, or currency values. A sudden market shift can affect your positions unfavorably. Impact of economic events. Economic factors, like central bank announcements or geopolitical tensions, can shift market dynamics. For example, a news report about trade disputes can lead to immediate volatility in currency derivatives. Hedging strategies. To manage market risk, companies may use hedging strategies to offset potential losses. It's crucial to monitor your positions regularly and adapt your strategies as needed. Regulatory risks. Regulatory risks involve changes in laws and regulations that govern OTC derivatives trading. These shifts can directly influence market operations. Increased oversight. In recent years, regulatory bodies have been focusing on OTC trading to enhance transparency. New compliance requirements can increase operational costs and complicate trading procedures. Impact of global regulation. Different countries may enact varying regulations affecting cross-border trading. This can lead to uncertainty for firms operating internationally. Staying informed about regulatory changes in key markets is critical. Adapting to changes. Firms must be ready to adapt their strategies to align with new regulations. This may involve investing in compliance systems or adjusting trading practices. In the world of OTC derivatives, understanding these risks is just as important as seizing opportunities. Are you prepared to navigate these challenges? Knowing these potential pitfalls can inform your trading strategies, making you a more informed participant in the market. The role of OTC derivatives in hedging. OTC derivatives play a crucial role in risk management for many companies. These financial contracts help businesses protect themselves against price fluctuations, interest rate changes, and currency risks. Let's look at 2 key areas where OTC derivatives shine: hedging against price fluctuations and managing interest rate and currency risks. Hedging against price fluctuations. Many companies use OTC derivatives to shield themselves from unpredictable price changes. Here are a few examples. Commodity producers. A farmer might enter into a forward contract to sell their crops at a set price. This keeps their income stable, even if market prices drop. It's a way to safeguard against the unpredictable swings of nature and market demand. Manufacturers. A car manufacturer may use options to hedge against rising steel prices. By locking in prices, they can plan budgets and avoid sudden cost surges. Airlines. Airlines often use fuel hedging contracts to manage the risk of fluctuating oil prices. If oil prices rise, these contracts allow them to purchase fuel at preset prices, protecting their profit margins. These strategies showcase how OTC derivatives allow companies to customize their risk management tools, making them essential for operational stability. Interest rate and currency risk management. OTC derivatives, particularly swaps and options, are effective tools for managing interest rate and currency risks. Here's how they work. Interest rate swaps. Many businesses face interest rate risk, especially if they hold loans with variable rates. Through interest rate swaps, a company can exchange its variable rate obligation for a fixed rate. This allows them to stabilize cash flows and manage budgeting more effectively. Currency swaps. Companies with global operations encounter currency risk due to exchange rate fluctuations. A US-based company selling products in Europe may face potential losses if the euro weakens. By using currency swaps, they can exchange cash flows in different currencies, thus hedging against unfavorable exchange rates. Options contracts. Companies can also use currency options to buy or sell currency at a predetermined rate. If the market moves unfavorably, they can choose not to exercise the option, limiting their losses. In these ways, OTC derivatives provide companies with customizable solutions to manage specific risks. They enhance financial strategies by allowing firms to protect themselves from unexpected changes. Are you considering how these instruments might support your risk management strategies? OTC derivatives market participants. The OTC derivatives market is diverse, with various participants playing critical roles. Understanding who is involved and how they operate enhances your grasp of this financial territory. Financial institutions. Banks and other financial firms dominate the OTC derivatives market. They act as both market makers and brokers, facilitating trades between buyers and sellers. Here's how financial institutions contribute to this landscape. Market makers. These firms provide liquidity. They are always ready to buy or sell derivatives, ensuring smooth transaction flow. This helps prevent big swings in prices due to a lack of trade activity. Risk management. Financial institutions use OTC derivatives to hedge their risks. For instance, banks might use interest rate swaps to manage the risk of changing rates on loans. Advisory roles. Many banks offer advisory services to their clients, helping them choose suitable derivatives. Their expertise in structuring contracts aligns with the specific needs of corporations. Counterparty for corporations. Financial firms often serve as counterparties to corporate trades. This means they take the other side of a transaction, which can help in managing their risk exposure while also offering companies tailored solutions. Corporations and businesses. Non-financial corporations also play a significant role in the OTC derivatives market. They use these financial instruments primarily for risk management. Here's how they engage. Hedging exposures. Many companies hedge against risks like fluctuating commodity prices, currency exchange rates, or interest rates. By using forward contracts or options, they can stabilize their financial outcomes. Operational needs. Businesses tailor OTC derivatives to meet their specific requirements. For example, a multinational company might use currency swaps to manage the risk of foreign transactions, ensuring predictable cash flows. Investor relations. Corporations often engage with financial institutions to create the best structures for their derivatives. This relationship helps them navigate complex financial landscapes and fulfill investor expectations. Strategic planning. OTC derivatives aid in long-term planning. By locking in prices for commodities like oil or steel, companies can create more accurate budgets and forecasts. Understanding the roles of various market participants highlights how the OTC derivatives market functions. Are you familiar with how these players interact and adapt in a constantly changing environment? Knowing this can deepen your understanding of risk management strategies. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.